Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Dan Schwartzman. Doug Krisner is off this week. President Trump and Chinese President Xi Jinping will meet next week on the sidelines of the Asia-Pacific Economic Cooperation Summit in South Korea. That's according to the White House. The meeting will be the first face-to-face for both leaders since Trump became president for his second term. Here's Press Secretary Caroline Leavitt making the announcement.
On Thursday morning local time, President Trump will participate in a bilateral meeting with President Xi of the People's Republic of China before departing to return home to Washington, D.C.
This comes as a trade truce between Washington and Beijing is set to expire on November 10th. Ahead of Trump and Xi's meeting next week, Treasury Secretary Scott Bessent is expected to meet with his Chinese counterparts. These talks are aimed to de-escalate trade tensions inflamed by new Chinese rare earth curbs and U.S. tariff threats. Meantime, China has wrapped its fourth plenum session in Beijing. Chinese Communist Party elites vowed to enhance technological self-reliance and grow the domestic market in the next 5 years. For more, we heard from Peiqian Liu, economist at Fidelity International Asia. Liu spoke to Bloomberg's Annabelle Droulers and Avril.
First off, your thoughts on what came out of the Chinese plenum, that consumption push didn't come in as strongly as some maybe had expected.
Yeah, thank you for the question. I think the plenum concluded with a communique, so we don't get the full picture yet. But scratching from the surface, it points to largely a continuation of what their plan has been for the last 5 years, which primarily is about tech self-sufficiency and it's about maintaining the manufacturing dominance within the global landscape. So those came as the top two priorities for the communique. And expanding domestic market, of course, pointing to more consumption is also on the list of priorities, but it's ranked third currently.
Do you think it needs to be more aggressive then in expanding that? Because we did hear from the likes of Stephen Roche just a day ago that there is more urgency on that for the Chinese economy than in the past. How much do you think should be done for consumption as a portion of GDP?
I think with regarding to this question, it's probably useful to bring the context of dual circulation. If we think about China's long-term goal of expanding and establishing a dual circulation model, the past 5 years was probably more about leaning on the external circulation, which they have been formulating. So as evident today, exports has been one of the major drivers of GDP growth. But we all know that's perhaps not sustainable, especially given the complexity of external environment. So in the next 5 years, I would envision them, it's actually alluding to as well in a communique that they will start expanding the domestic market. So building up this domestic circulation is perhaps a pivot and recalibrating within the grand scheme of the dual circulation model.
But dual circulation and lifting consumption, Peiqian, has been a long-standing effort from the company, or government rather, as well. And we've seen lots of different mentions of this. How do they actually go about doing it in reality? And what can you actually feasibly do to lift consumption when you've got the big sort of elephant, which is property prices, still in the doldrums?
Yeah, that's exactly right. The economy is currently strong and weak at the same time. So when we talk about consumption, it's perhaps from both cyclical and structural lens. From a cyclical perspective, we are in the view that consumption does need a lot more support. So that's also baked in our expectation for next year in 2026, where the government will likely to roll out more support towards domestic consumption. But from the structural perspective, I think the communique from the plenum has also been emphasizing that keeping a reasonable range of manufacturing share to GDP is also one of the priorities. So structurally, I think expanding domestic market will perhaps be put on the lens of expansion of growth altogether, so growing the pie rather than redistributing the pie in the next 5 years.
Then it sounds like it's going to come more from the fiscal side rather than the monetary policy. Of course, rates are already quite low and they're sort of constrained on that front. What would be the steps that you would expect then?
I still think fiscal will likely to lift the heavy weight, especially from the central government. So in 2026, will likely to be a continuation, if not slightly more expansionary policy stance towards social welfare, towards household consumption. So a little bit more transfer from the central government to the household will likely to be helpful for the rebalancing. As you mentioned, that monetary policy is perhaps having slightly less room. Nonetheless, I still think that monetary policy will tilt towards easing, so gradual ease of benchmark rates and triple R cards are also still on the cards.
It's really about how much stimulus they can provide in the face of U.S. pressure. So I wonder, what is your base case and best case for the Trump-Xi meeting next week as their U.S.-China economic relationship shapes up?
That's right. I think the U.S.-China relation, or just at large, the external environment, is part of the reaction function as well, given how important export has been contributing to GDP growth. So given that context, the base case expectation for U.S.-China meeting coming up is perhaps no further escalation from here. And to move a little bit more to the optimistic scenario, I think a walk back from the recent escalations will likely to be helpful and beneficial for China's continued exports prowess.
That was Peiqian Liu, economist at Fidelity International Asia, speaking to Bloomberg's Annabelle Droulers and Avril. Coming up next, we'll hear from Bloomberg's Mark Cranfield for the check of the markets. Welcome back to the Daybreak Asia podcast. I'm Dan Schwartzman. Doug Krisner's off this week. Asian stocks opened higher as a planned meeting between President Trump and Chinese President Xi eased nerves around trade tensions. The dollar was little changed ahead of U.S. inflation data, with investors expecting the Federal Reserve to announce a rate cut next week, despite inflation being above the Fed's goal. For more, we turn to Mark Cranfield, Bloomberg's M-Live strategist. He spoke to Bloomberg's Annabelle Droulers and Avril on the Asia trade.
There's no lack of things to digest. We had Japan CPI numbers. We're waiting out for the US CPI ones. And all this coming ahead of the Fed and BOJ meets next week. What is your take on where things go from here?
Well, you haven't even mentioned Trump and Xi meeting as well, which we hope they will meet. They will not be cancelled. That's a very big deal for financial markets. As Bill was saying, the tailwinds are good for markets. This CPI report that comes out from the US tonight is a little bit isolated because we've been lacking data from America. Most of it has been cancelled over the past few weeks because of the government shutdown. So we're going to get this one piece of data. No doubt there'll be knee-jerk reactions, whatever it is, whether it's high or low. But the Fed will have difficulty in making too much of it because it is just one thing, and they've been missing a lot of the other reports, GDPs and employment data and that kind of thing. And they've been very focused on the jobs numbers. Now, there's a jobless claims report we're expecting to see, but it's also backdated. The indications from that will probably be that the employment situation is still fairly soft. And that's really what the Fed is more interested in, along with the possibility of stopping their reductions in the balance sheet. Now, the Fed balance sheet became very big. It's a hot topic of conversation, whether or not it's time for them to stop reducing it and effectively help the situation in America. It's another form of easing. If they do that, it's not as good as an interest rate cut, but along with an interest rate cut, it works very nicely, and it would mean that investors will be pretty happy. That may be announced next week.
You mentioned the Trump-Xi meeting and how important it is for investors. What does it mean for the yuan? Because we just had the Plenum as well wrapping up. This prospect for any sort of near-term stimulus is dimmed. That's probably a negative for the yuan. And you can add the fixing as well. And we're consistently being anchored around that 710 level.
The Plenum and the 5-year plan itself doesn't tell you a great deal about the currency. However, where the PBOC will be starting to get concerned is the exchange rates in relation to the yen and the Korean won. Now, they're big trading competitors for China, and those currencies have been weakening pretty fast against the Chinese currency. Now, there will be a certain point at which we've been seeing very steady fixings from the PBOC every day. The daily fixing has been implying that the yuan should stay on a strong path. There will be a limit to how far the Chinese central bank is willing to do that if the yen and the yuan go to even weaker territory, because those cross rates are very important. They're getting close to levels that the PBOC, the alarm bells will be going off in their headquarters pretty soon unless Korea and Japan do something to stop the slide in their currency. If they don't, the response may come from China. We will see it through the daily fixing. Suddenly, they will step back and they will allow the fixed dollar yuan fixing to go higher. And that will be an indication that they are worried about what's happening in relation to other Asian currencies. We're not there yet, but you can see it's pretty much on their radar because those cross rates are close to very key levels for the Central Bank of China.
Also on the radar, I guess, when you look at this interplay of currencies, is how the weakness and the yen and the Korean won comes. These are countries that have investment pledges as part of their trade deals with the US. I mean, is that just another layer of complication when it comes to the FX moves?
Definitely, if they don't make it clear about how they're going to come up with that money. So there are many ways they could do it. If it's just pure foreign exchange transactions, that's a concern for the market because that is just outright buying of US dollars and it would just make the current situation even worse. They could do swaps. That would be a neutral effect on the market. They could raise the money via debt and do off-market swaps with the Federal Reserve. There are many ways of massaging it and doing it in a way that doesn't really impact the foreign exchange market. But if they need to make that clear to investors. At the moment, they're in a bit of a vacuum. They're not really sure. They've seen these big numbers, 350 billion or more, and they're getting a little bit worried because they're assuming that the central banks, they're just going to go straight in the market and buy the fresh US dollars. And that's partly why you're seeing the currency moves in that direction. It's also related to central bank policy as well. So it would help a lot if the authorities in Japan and Korea made it clear to investors how they're going to go about financing it and making sure it's a relatively neutral impact on the currency markets.
That was Mark Cranfield, Bloomberg's MLive strategist, speaking of Bloomberg's Avril Hong and Annabelle Droulers on the Asia trade.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.